Hey, have you ever stared at a stock chart and wondered, what's going on here? Up, down, zigzag? What's the deal? Don't worry. Today we're diving into price action trading, a method that'll help you decode the market's moves. I'm Trading Core, and in the next 10 minutes, we'll break down price action in the simplest way possible. No jargon, no nonsense, just practical knowledge for traders like you. Ready? Let's get started. Price action is like the pulse of the market. It tells you what the market is thinking, and you get all this from a simple chart. No fancy indicators, no complex math, just the raw movement of prices. Price action is about understanding why prices move based on what buyers and sellers are doing. In trading, we use candlestick charts to see this action. Each candle shows what the price did in a specific time frame. A green candle means buyers won. A red candle means sellers took over. Pretty straightforward, right? When you look at these candles together, they tell a story, the market's story. Price action trading is about reading this story and making smart trading decisions from it. So, why is price action a big deal, especially for us traders? Our markets, whether it's NSE or BSE, are super dynamic. One day Nifty 50 is soaring, the next it's crashing. News, FIIS, DIIS, global cues, everything impacts it. But price action gives you a clear lens to cut through the noise. Instead of juggling 10 indicators that leave you confused, price action shows you the market's real-time mood. For instance, if Reliance Industries forms a big green candle with high volume, it could mean big players are buying. Or if the price stalls at a resistance level, say 3,000 rupees, it's a hint that sellers might step in. Plus, price action works everywhere. Whether you're trading Tata Motors, Bitcoin, or gold, it applies across markets. For Indian retail traders who are growing by the day, this gives you an edge without hours of complex analysis. Let's dive into the core of price action. There are three big concepts every trader needs to know: support and resistance, candlestick patterns, and trends. Let's break them down one by one. Support and resistance. Support and resistance are like the market's invisible walls. Support is a level where the price dips but bounces back up, like a trampoline. Resistance is where the price climbs but gets stuck or falls back. For example, if HDFC Bank's stock keeps bouncing back from 1,500 rupees, that's a support level. If it struggles to break 1,600 rupees and falls, that's resistance. These levels help you decide when to buy or sell. Breakout traders wait for the price to smash through these walls. Candlestick patterns. Next up, candlestick patterns. These are like small signals that reveal the market's mood. Here are a few key ones. Doji. A tiny candle where the open and close prices are almost the same. It shows the market is unsure. Buyers and sellers are in a tug of war. Hammer. A candle with a long lower wick. It suggests buyers stepped in to push the price back up. Engulfing. A big candle that completely covers the previous smaller one. A bullish engulfing shows buyer strength, while a bearish one signals sellers. You can spot these patterns on stocks like Infosys or ITC. It just takes a bit of practice. Trends. Finally, trends. The market moves in three ways: uptrend, downtrend, or sideways. In an uptrend, prices make higher highs and higher lows, like Nifty 50 during a bull run. In a downtrend, it's lower highs and lower lows. Sideways means the price is stuck in a range. Price action traders spot these trends and trade with them. For example, if Adani Enterprises is in an uptrend, buying on dips could be a smart move. How to start with price action. So, how do you start with price action trading? Here's a simple three-step plan. Use a demo account. Open a demo account on platforms like Zerodha or Upstocks. Practice without risking real money. Try price action on Indian stocks or Nifty futures. Focus on one stock. Start with just one stock or index like Nifty 50. Study its support, resistance, and patterns. Keep it simple. Stick to 2 to 3 candlestick patterns or concepts. Don't clutter your charts with too many indicators. Price action is enough. And most importantly, be patient. Trading isn't a get-rich-quick scheme. Practice, study charts, and start understanding the market. Here are 6 advanced price action strategies that top traders use for Indian stocks and indexes. We'll go deep into each so you really get it. Let's roll. Fair value gap. First, fair value gap, or FVG. This happens when the market moves so fast it skips a price zone, creating an imbalance. Imagine 3 candles on a Nifty 50 chart. The first candle's high and the third candle's low don't overlap, leaving a gap. That's the FVG, a zone where trading didn't happen properly. Why does it matter? FVGs act like magnets. The market often retraces to fill this gap before continuing its trend. For example, if Nifty jumps from 24,000 to 24,200 due to a big news event, leaving a gap, it might return to 24,100 before resuming. To trade it, wait for the price to revisit the FVG, say, with a bullish candle for a buy in an uptrend. Confirm with volume or a support level nearby. This works for stocks like Reliance, too, especially after earnings spikes. ICT order blocks. Next, an ICT concept, order blocks from Inner Circle Trader. These are zones where big players like institutions place trades, driving big moves. An order block is typically the last bullish candle before a sharp drop or the last bearish candle before a rally. For example, if HDFC Bank drops from 1,600 rupees, look at the last green candle before that drop, say around 1,580 rupees. That's your order block. Big players likely sold there, and the price often returns to this zone before continuing the trend. To trade, wait for the price to retest the order block with a rejection candle or strong volume, then enter in the direction of the trend. For HDFC, buy if it's an uptrend retest with a bullish signal. These are gold for Nifty futures too. ICT liquidity grabs. Another ICT concept. Liquidity grabs. Big players like FIIs hunt retail traders' stop losses to create liquidity. Imagine Tata Motors stuck at 1,000 rupees resistance. Retail traders place stop losses just above, say 1,005 rupees. Institutions push the price up to trigger those stops, then reverse it fast. On a chart, look for a quick spike above a key level, like Tata Motors hitting 1,005 rupees, followed by a sharp drop. That spike is the liquidity grab. To trade, wait for the reversal signal, like a bearish candle after the spike, and enter a short trade. For a buy, look for a dip below support that reverses up. Confirm with volume or candlestick patterns. This happens often in volatile stocks like Adani Enterprises. To see other 3 price action concepts, make sure to subscribe and hit the bell icon, and I will see you in the next VIDE. Stay tuned.